Welcome to the Deep Dive. Today we're digging into a company that's, well, basically shaped the global digital scene for 2 decades.
Alibaba. Yeah, I mean, for years it was the name in Chinese e-commerce, just this massive centralized empire.
Exactly. But that whole era, it's over now.
It really is.
So our mission today is to unpack what's happening inside a company going through, honestly, one of the toughest, most necessary transitions you could imagine.
It's a huge structural shift. They're moving from that single giant
Right, the monolith.
to this really decentralized holding company. And they've got a totally new game plan, a dual focus, really.
Centered on AI and cloud, right?
I thought the core of it. Look, this isn't just a simple pivot. It's like corporate evolution sped up under incredible pressure.
And the source materials we've got really highlight that.
They do. There are kind of two big stories here. First, you absolutely have to understand the company's roots, its DNA, and that's tied up with the founder, Jack Ma. His story is almost legendary.
Almost mythical, yeah.
And then second, we need to get into the weeds of the current strategy. This Baba 2.0, the 1+6+N restructuring. It's complicated.
So for you listening, the real goal here is to get your head around the massive trade-offs Alibaba is forced to make.
Exactly. They're basically sacrificing short-term profits, spending big to make this pivot work.
And they're doing it while fighting off fierce competitors and dealing with, well, unpredictable government regulators.
It's a pressure cooker.
Definitely. And our source stack reflects that complexity. We've got strategic analyses covering the new structure, the latest Q2 financials, which are really interesting.
Especially with PDD and doing breathing down their necks.
Right. And crucially, we're balancing that with a fantastic historical case study. It really captures Jack Ma's entrepreneurial spirit, the early fights that made them dominant in the first place.
So you get the context and the current battle plan.
Okay, let's dive in. Let's unpack this transformation, starting right back at the beginning. Jack Ma's story feels like the essential place to start, mainly because it's such a stark contrast to the, super-managed corporate giant they became later.
Absolutely. He was maybe the most unlikely tech founder imaginable.
Right. Not some Silicon Valley coder.
Not at all. He was an English teacher in Hangzhou, making, the equivalent of $12 a month back then?
Yeah, peanuts. And he famously bombed the Chinese university entrance exam. How many times?
3 times. He wasn't some privileged Harvard dropout finding startup cash easily.
No, completely self-made. He faced failure after failure before anything clicked.
And that struggle, that history, it really defined the company's early vibe, its culture.
So what was the turning point? When did the internet thing happen for him?
That was 1995. He took a trip to the U.S., saw the internet for the very first time.
Yeah, the story is he searched for beer.
Yeah, the famous anecdote, he types in beer, gets results from Germany, the U.S., everywhere, but nothing from China. 0.
And that was the moment.
That was the light bulb. He instantly saw it. China, this huge country with thousands of years of trade history, had basically no presence online.
A massive, untapped market just sitting there.
The biggest opportunity in the world, right in front of him.
So he jumps right in, goes back home, starts China Pages in '95. Like an online Yellow Pages for Chinese businesses.
Exactly, trying to connect them to the world. But that first try, it failed pretty spectacularly, actually.
Not just financially, right? Didn't he lose control?
Yeah, the accounts suggest he got tangled up with China Telecom, a huge state-backed company, and basically lost control of his own venture.
Ouch. So first attempt ends in failure and getting pushed out.
But that's the resilience piece, right? He didn't quit. 4 years later, 1999, he tries again.
This time with backup.
Yeah, gathers 17 friends, former students, in his tiny Hangzhou apartment. And that's when Alibaba.com, the B2B marketplace, was officially born.
And the name Alibaba. Where did that come from? That's memorable.
It's great early marketing, actually. Idol told this story about being in a coffee shop in Malaysia.
Okay.
And just asking random people, what do you think of when you hear Alibaba? And everyone instantly thought of Open Sesame.
Opening up the treasure cave, the market.
Exactly. Opening up this vast hidden market. Perfect name.
And investors bought into that vision pretty quickly, didn't they? Especially given the timing.
Surprisingly fast. Within just a year, they got real money. $5 million from Goldman Sachs. And then $20 million from SoftBank. That's the Japanese tech investment giant. The source actually makes a point of clarifying they're Japanese.
Right, because tracking foreign capital was already important back then.
Yeah, for compliance reasons. And that $25 million, they got it right before the dot-com bubble burst globally around 2001.
Talk about timing. So how did they survive when everyone else was collapsing?
Just incredible early discipline. Mara somehow steered them to actually be profitable by 2001.
Profitable in 2001. That's amazing.
It really is. They survived what was basically an extinction event for tech startups worldwide.
Okay, so they survived. But China had unique problems for e-commerce, right? Like trust.
Huge problems. In the early 2000s, almost nobody, like less than 1% of people, had credit cards.
And people just didn't trust buying online, sending money to strangers.
Absolutely not. There was this deep-seated lack of commercial trust. You wouldn't just send money off and hope something showed up.
So how did Alibaba crack that? They couldn't grow without solving it.
They had to invent the solution. And that solution was Alipay, launched in 2004.
The Chinese PayPal, basically.
Sort of, but crucially different. It wasn't just processing payments. Alipay acted as a neutral third party, like an escrow service.
Ah, so it held the money.
Exactly. It held the buyer's money safely until the buyer confirmed they'd received the order and everything was okay.
That's clever. Removes the risk for the buyer.
Fundamentally, that small structural change, creating that trusted middleman, that's what unlocked mass adoption of e-commerce across China. It solved the trust deficit.
Okay, so they built the trust foundation. But then the competition arrived. The big one, eBay.
Right. This is where Ma's Be Fearless principle gets tested. 2003, eBay comes roaring in.
And they didn't just start from scratch, did they?
No, they bought EachNet, which already had something like 80% of China's consumer-to-consumer market. 80%. eBay was the global king of online auctions.
So how did Alibaba respond, this tiny startup against a global giant?
With pure audacity, the classic guerrilla move, as the source calls it. They immediately launched Taobao, their own CDC platform, to go head-to-head.
Okay, direct challenge. But how could they compete on features or funding?
They didn't compete on features, they competed on price. eBay made money charging fees, listing fees, transaction fees. Lee's counter. He announced Taobao would be completely free for 3 years.
Free.
Totally free. It instantly vaporized eBay's revenue model in China. Merchants obviously flocked to the free platform.
It's gold. Cut off their oxygen supply.
And the marketing was just as aggressive. It shows that early culture again. Alibaba employees weren't just coding.
They were soldiers.
Basically. They were tasked with, quote, pummeling online message boards, forums, everywhere, with positive comments about Taobao. Just driving awareness, building hype.
Wow, an all-out online guerrilla war.
Absolutely. And it worked. By 2006, eBay essentially threw in the towel, turned over their Chinese operations to a local partner.
They got chased out.
Effectively chased out of China by Taobao's free model and Alipay's trust system. An incredible David versus Goliath win.
And that victory must have cemented their dominance and that unique culture.
For sure. The source talks about this really lighthearted atmosphere, very different from typical Chinese companies. They had these Alifest talent shows.
Right, I've seen pictures. Executives in costumes,
Yeah.
Jack Ma singing.
Yeah, famously singing pop songs in crazy outfits. It wasn't just fun, it built this charismatic, bold brand image. Fueled loyalty, excitement.
And the money started rolling in after that. Big milestones.
Huge ones. 2005, Yahoo invested $1 billion for a 40% stake. Massive validation.
$1 billion back then was serious money.
Then they listed in Hong Kong, 2007 to 2011. But Ma had this specific idea about control.
The dual-class shares, like Facebook.
Exactly. He wanted a structure where founders kept more voting power, even with less equity. Hong Kong wouldn't allow it.
So he delisted. Just walked away.
Yep. Pulled the plug. Which then led directly to the monster U.S. IPO in 2014.
The biggest ever at the time.
Raised $25 billion. Just fueled years of dominance. Taobao ended up with like 75% of all online sales in China.
Incredible scale. Remember those Singles Day numbers?
Yeah. Singles Day 2015, $14.32 billion in sales in one day. Just mythological scale.
Mythological is the right word, but as we know, myths often end.
Yeah.
And that era of unchecked growth definitely hit a wall, which brings us to the big turning point.
Yeah, that period around late 2020 going into 2021,
Yeah.
That was it. The inflection point, no question. It marked the end of decades where the government was pretty hands-off with big tech.
And the first big shockwave was the Ant Group IPO getting pulled, right? November 2020.
Abruptly pulled, days before listing. That was Beijing sending a very clear message, a line in the sand.
What was the message? Too big? Too influential?
Both, probably. The state showing it was determined to rein in these massive tech conglomerates, maybe worried they were getting powerful enough to challenge government policy.
And then came the hammer blow 5 months later, April 2021.
The huge fine. $2.8 billion imposed by SAM, the market regulator.
The biggest anti-monopoly fine ever in China at that point. What was the official reason?
Exclusionary abuse, specifically forcing merchants into those choose one from two exclusivity deals. You sell on our platform, you can't sell on our competitors.
Common practice, maybe, but regulators cracked down hard.
Extremely hard. And the sources really stress how this shifted the whole risk picture. For years, Alibaba was seen as aligned with government goals, even protected.
Well, man.
Now, the crackdown implied the government saw these tech giants as potential challengers to its own authority, its control over the economy.
So for investors, the risk profile just flipped overnight.
Completely. It went from standard business and competition risk, which you can analyze, to this unpredictable, potentially severe political and regulatory risk.
How do you even price that? How does a company navigate that kind of uncertainty?
It fundamentally changes everything. And layered on top of that political shift is this other persistent structural risk, something called the VIE framework.
Right, the variable interest entity. Explain that simply. Why does it exist and why is it a risk?
Okay, so the VIE is basically a legal workaround. China restricts foreign ownership in sensitive sectors like the internet.
So foreigners couldn't directly own shares in Alibaba operating in China?
Correct. The VIE structure lets them get around that. You set up a shell company, often in the Cayman Islands. That shell company is what gets listed on, say, the New York Stock Exchange.
Okay, so U.S. investors buy shares in the Cayman Shell Company.
Exactly. Then that shell company has contractual agreements with the actual Alibaba companies operating inside China.
Contracts, not ownership. That sounds fragile.
That's the risk. It creates two big issues. First, the actual Chinese operating companies are usually owned by a handful of Chinese nationals.
Like Ma and a few others initially.
Right. Their interests might not always align perfectly with the foreign shareholders who only own the shell company. That's a conflict of interest risk.
And allocation risk.
Yeah.
Can they guarantee profits flow out to the shell company?
That's the second risk, the allocation risk.
Right.
It relies on contracts, not direct ownership. And then there's the geopolitical layer.
U.S.-China tensions.
Exactly. Things like the U.S. Holding Foreign Companies Accountable Act, the HFCAA. There's this constant background noise, this legal ambiguity about whether these VIE structures are truly stable, whether audits are sufficient, the risk of U.S. delisting.
So even if things are fine now, the structure itself keeps a lid on the valuation.
Precisely. Investors have to price in that uncertainty. It means Alibaba likely always trades at a discount compared to, say, a purely U.S. tech company without that structural issue.
Okay, so faced with this regulatory crackdown and this persistent VIE risk, Alibaba had to make a big move. Not just because of competitors, but for survival.
You got it. The massive restructuring we're about to talk about, it wasn't just about making things run better. It was a defensive maneuver driven by these existential threats. Absolutely nailed it. The 1+6+N plan, announced March 2023, was exactly that. Their big structural defense.
The biggest reorganization in their entire 24-year history, right?
Yeah.
Flipping Jack Ma's centralized model completely.
Total reversal, and the main goal, well, was complicated.
Efficiency was part of it, surely. Making decisions faster.
Yes, enhancing agility, shortening those long decision chains, that was definitely stated. But arguably, the bigger driver was mitigating that monolith risk.
Breaking up the perceived single giant.
Exactly. By splitting into these major groups, allowing them to operate more independently, raise their own capital, maybe even IPO separately.
So each piece looks smaller, less threatening to regulators.
That's likely a major part of the calculus. Plus, the theory is it unlocks the specific value of each distinct business. The market can value the cloud business differently from e-commerce, for example.
Okay, let's list the 6 main groups again, just to be clear.
Right. You've got CIG, the Cloud Intelligence Group, that's cloud and AI. T&T, Taobao Tmall, the core domestic e-commerce engine. LSG, local services. AADC, the global arm AliExpress, Lazada. Cainiao, the logistics network. And DM, digital media and entertainment.
And the N is for?
Smaller bets, future innovations they might spin out later.
Now, you mentioned they could all potentially IPO, raise outside funds.
Yeah.
But there was one huge exception, T&T.
The exception that proves the rule, really. T&T, the domestic e-commerce heartland, stays 100% owned by the Alibaba Group holding company.
Why is that non-negotiable?
Because it's the cash cow. It's the incredibly profitable engine that funds everything else. The AI investments, the global expansion, paying for the defense against PDD. They simply cannot afford to lose control or the full fire hose of cash flow from T&T.
Makes sense. Protect the golden goose. Now, this huge restructuring was quickly followed by a leadership change,
Right.
September 2023.
Yeah, Joseph Tsai, another co-founder, took over as chairman from Daniel Zhang. And Eddie Youngming Wu, also a co-founder, became group CEO.
Was this just musical chairs, or was there a strategic point, maybe nudged by the regulators after the crackdown?
It's hard to say definitively it wasn't influenced by the political climate, but
Yeah.
the outcome is strategically crystal clear.
How so?
Look at Eddie Wu's roles. He's not just group CEO. He also took the job of chairman and CEO of CIG, the Cloud Intelligence Group.
Running the whole company and personally running the cloud division.
That's the ultimate signal. It puts AI and cloud front and center, absolutely non-negotiable. It bakes the technical vision right into the top level of strategy.
And Wu have the tech background.
Deep tech roots, co-founder. His vision is explicit. Generative AI is going to, quote, take over the digital world and transforming the physical one.
So the whole structure, leadership included, is now geared towards backing that massive, expensive, long-term AI bet.
Top-down alignment for the Birrier 2.0 mission.
Okay, let's connect this strategy shift to the actual numbers. The Q2 results for fiscal 25 really show the strain, right? There's this weird contradiction.
Yeah, a massive dichotomy. On the surface, consolidated revenue was up slightly, about 5.2%, hitting RMB 236.5 billion. Modest growth.
But the operational profit, the adjusted EBITDA, actually went down 5% to RMB 40.6 billion. How does revenue go up but profit go down?
That's the cost of the strategy tax, basically. That 5% drop in operating profit is almost entirely due to deliberate heavy spending.
Spending on what specifically?
Two big things. Aggressive user acquisition, trying to get and keep customers, and investing heavily in quick commerce.
What's quick commerce exactly? Like grocery delivery?
Yeah, things like community group buying, fast local delivery, often low margin, high frequency stuff. They're basically subsidizing these services.
Why? To fight off competitors.
Exactly. It's defensive spending, aimed squarely at fending off the value-focused players like PDD Holdings, but it absolutely bleeds their margins.
Okay, so operating profit is down because they're spending a ton to defend their turf.
Yeah.
But then the headline GAAP net income number looked amazing, right? Up 63%.
Massively up to RMB 43.5 billion. And yeah, if you just saw that number, you'd think things were fantastic. Very misleading.
So where did that GAAP profit surge come from?
Almost entirely from non-core stuff. One-time gains. They sold off assets they didn't see as strategic anymore.
Like those SunArt and In-Time retail businesses?
Exactly. And a partial sale of their stake in Trendyol, the Turkish e-commerce firm. Plus some investment gains. It's portfolio tidying, not core business strength.
So the takeaway is, ignore the GAAP surge. Focus on the operational margin pressure.
Absolutely. That pressure tells the real story of the core business fight. It's under stress, but still generating the cash.
Okay, let's zero in on that core domestic fortress, TNT. It's under attack. How are they trying to stabilize margins there, despite the spending?
The key lever is their advertising income, what they call customer management revenue, or CMR. That's the high margin stuff.
How did CMR do?
Surprisingly well, actually, up 10% year over year. And they managed that mainly by increasing their take rate.
The percentage they keep from each sale on the platform, how did they boost that?
Primarily through pushing adoption of their own fancy marketing tool. It's called Kwanzantui, or QZCT.
Okay, pause here. QZT, this sounds important. Like the aha moment for their internal profit potential.
It really is. QZT isn't just like buying banner ads. It's this sophisticated, algorithm-driven system.
What does it do for merchants?
It pushes them towards using automated, full-site advertising campaigns. Merchants use the tool, get better optimized ad placements across Taobao and Tmall.
Okay, sounds good for them.
Yeah.
But how does it boost Alibaba's take rate?
Because it uses an algorithmic bidding process. Merchants basically compete against each other, automatically bidding up the price for the best placements.
So the system itself drives up ad prices and Alibaba's cut.
Inherently, it forces merchants to pay more for visibility, which directly increases the platform's high-margin take rate. Clever mechanism.
And the source pointed out a huge gap here compared to competitors.
A really striking gap. Right now, Alibaba says the penetration rate for QZT, the percentage of merchants actually using this powerful tool, is only around 30%.
Only 30%.
Okay. Now compare that to their main rival, PDD Holdings. PDD apparently got its equivalent tool adopted by an estimated 80% of its merchants within just 3 years.
Wow. 30 versus 80%?
Yeah.
That difference.
Yeah.
That's a massive untapped revenue stream sitting right there for Alibaba.
Exactly. This is their big internal lever. They don't even need to win back market share immediately if they can just get more of their existing merchants to use QZ2.
They can drive significant high-margin revenue growth regardless of the external battles.
Correct. It's an efficiency and monetization play they can control internally. Huge potential.
And we see that focus on efficiency elsewhere too, right? That all others segment revenue dropping sharply.
Yeah, down 28%. That's mostly because they offloaded those non-core assets, SunArt and In Time. It shows management is serious about streamlining, cutting fat, and focusing resources purely on the core fights, defending TNT and accelerating the cloud business.
Okay, shifting gears now to that future engine. CIG, the Cloud Intelligence Group. This is Eddie Wu's baby, the division meant to justify all this pain and cost.
Absolutely the long-term growth pillar, where the big strategic bet lies.
Right now, cloud revenue growth is, well, okay, 7% year over year, mostly driven by AI-related demand, they say.
Yeah, 7% is decent, but not spectacular compared to the global leaders.
Yeah.
But the forecast, the expectation is for a massive jump.
Oh, massive.
Analysts are talking about that growth rate potentially surging towards 30% over the next few quarters.
30%? Where's that sudden growth spurt going to come from?
It's all about enterprise demand for AI infrastructure. Think big industries, car makers, education tech companies, media production houses.
We all need computing power for AI models.
Exactly. They're all scrambling to train their own proprietary large language models now. Alibaba Cloud wants to be the go-to provider for that compute capacity, especially within China.
Okay, but globally, they're still pretty small fish compared to AWS or Azure.
Oh, yeah. Globally, CIG only has about 4% market share. AWS is way out front at 30%, Azure around 20%. It's a tough global fight.
So the strategy is China first.
Dominate domestically first. And they are. In China's AI public cloud market, they have almost 25% share. #1 for 2 years straight. And that specific market in China grew like 55% last year. It's booming.
So they're riding that domestic AI wave. And their big weapon seems to be open sourcing their AI models, the Quinn family. That seems different from U.S. companies.
It's a fascinating, counterintuitive strategy, and maybe their smartest move. They are fully committed to open sourcing Quinn.
Calling it the operating system of the AI era.
Right. The idea is make it free, make it open, encourage developers everywhere to adopt it, build on it, make it the standard.
But again, the business model question. If the core AI model is free, how do they make money?
It's what the source calls the inverted funnel strategy. It's brilliant, actually.
Explain the funnel.
Okay. You get massive adoption because it's free and open source. Quinn already has something like 600 million downloads, 170,000 derivative models built using it. Huge reach.
But the top of the funnel is enormous.
Exactly. But now, if you're a company wanting to use Quinn seriously at scale for real business applications, you need more than just the free model.
You need tools, security, power.
Precisely. You need their specialized platform for AI tools, or the PAI tools. You need advanced security features. And most importantly, you need the raw computing power, the high-margin compute capacity for training the models and running inference.
And where do you buy that capacity in those tools?
Only from Alibaba Cloud. So the free open source model acts purely as a massive customer acquisition engine, funneling users towards their premium, high-margin cloud infrastructure and services.
That makes perfect sense. The free software drives demand for the paid hardware and services.
It's a long game, but potentially very powerful if Quinn becomes a global standard.
And to support that global ambition, they need data centers everywhere, right?
They do. CIG is actively building out its international footprint. Plans announced for new data centers in Brazil, France, the Netherlands.
Expanding beyond Asia.
Yeah, and more planned for Mexico, Japan, South Korea, Malaysia, Dubai. It's a serious global infrastructure build-out.
Plus, tying up with NVIDIA.
Right, integrating NVIDIA's physical AI software stack. That gives them serious B2B capabilities to offer enterprise clients needing massive AI power. It completes the ecosystem picture.
Okay, before we hit the big competitive threats, quickly touch on the other two key divisions. ADC, the international e-commerce arm. That's about managing risk.
Yeah, ADC holding Lazada, AliExpress is their main hedge against a slowdown in China. It's been a big money loser historically.
Right, lots of investment.
But management has cracked down hard on costs. They've got the adjusted EBITDA loss margin down to almost zero, just negative 0.2% last quarter.
So close to break even.
And the stated goal is full profitability. If ADC flips from being a cost center to a profit center, that's another big win for the overall valuation.
And Cainiao, the logistics piece, they canceled its IPO, right?
Which did, back in March 2024. Cainiao is super important operationally, lowers costs for TNT and ADC, makes delivery faster, more efficient.
Using AI heavily, too.
Oh, yeah. The source mentions things like 80% accuracy in forecasting order volumes, AI boosting warehouse worker productivity by 30%. It's high-tech logistics.
So why cancel the IPO if it's so valuable?
The thinking now is that management decided keeping Cainiao's data and capabilities tightly integrated within the group was more valuable strategically than getting a cash injection from an IPO. That tight integration with TNT and ADC is a competitive advantage they want to keep in-house.
Okay, let's really synthesize this domestic e-commerce war, because it explains so much of the short-term pain, the margin pressure. Alibaba's fighting on multiple fronts.
It's incredibly tough. They face two very different, very dangerous rivals.
First up, PDD Holdings. Pinduoduo in China, Temu internationally.
PDD is all about value, rock bottom prices. They use gamification, group buying discounts, and this super lean consumer-to-manufacturer model where they connect buyers directly to factories.
Cutting out middlemen, keeping costs low.
Incredibly low. And it's worked. PDD's total sales volume, their GMV, is now thought to be bigger than JD.com's. That's a stunningly fast rise.
And the stock market rewards that growth, right? Looking at their PE ratio.
Yeah, PDD trades at a much lower forward price to earnings multiple, around 11.6x compared to Alibaba's nearly 19.6x. Now, valuations are tricky, but it suggests the market sees better growth prospects or efficiency at PDD right now.
Okay, so that's the value threat from PDD. Then there's the disruption from Douyin.
ByteDance is Douyin, the Chinese TikTok. That's a totally different beast.
How so? They're not just about low prices.
No, Douyin is disrupting the whole way people shop online. It's not about searching for something you already want. It blends entertainment, short videos, live streaming, and shopping all together.
Interest e-commerce, they call it. Discovering things you didn't know you wanted.
Exactly. Driving impulse buys through content, and it's exploding. Douyin quickly became China's third biggest online marketplace, grew over 33% last year.
So Alibaba's squeezed. They have to protect Tmall's high-end brands and margins.
While also spending heavily on low-margin quick commerce to fight PDD on value.
And somehow figure out how to compete with these in a super engaging, content-driven shopping model.
It's a strategic nightmare. You're fighting three different wars at once.
Which brings us back to the valuation. How do investors make sense of this?
Well, the bear case is pretty simple. The competition is brutal. The regulatory geopolitical risks are real. So maybe the stock doesn't have much upside from here.
But the bull case, what are the analysts focusing on?
The bulls, the consensus view, really sees significant undervaluation, but it relies on Alibaba executing on three specific measurable things. These are the catalysts.
The report card for the BBA 2.0 pivot we talked about.
Exactly. Catalyst number one, accelerating cloud growth. CIG has to start hitting those higher growth numbers, moving towards that 30% target. Prove the AI bet is working.
Okay, number two.
Continued QZT penetration. They need to keep boosting that high-margin CMR growth, probably aiming for at least 10% consistently by getting more merchants onto that QZT tool. Close that gap with PDD's adoption rate.
Number three.
International profitability. ADC needs to cross the line from costing money to making money, achieve full profitability, turn that division into a positive contributor.
So for anyone watching Alibaba, those are the three key metrics to track. CIG growth, QZT adoption, and ADC profits.
Those are the quantifiable signs that the strategy is working, that management can pull the internal levers needed to justify the restructuring and the spending, even while the external pressures continue.
And we should always remember, lurking in the background
is the VIE structure risk and the whole US-China geopolitical tension. That stuff isn't going away. It likely puts a permanent ceiling, or at least a discount, on the valuation compared to US peers. It's just part of the package. Hashtag tag outro.
You know, looking back, Alibaba's whole history is about tackling huge structural problems.
Yeah, first it was the lack of trust in online payments, which they solved with Alipay. Genius move.
And now it's this immense challenge of a complex corporate structure hitting regulatory walls and fierce competition.
Yeah.
The 1 + 6 + N is their answer.
It's a massive, expensive, but probably unavoidable trade-off, isn't it?
Seems like it. They're essentially burning cash short-term, letting operational margins slip.
To fund the fight in domestic e-commerce, especially that low-margin, quick commerce battle.
While simultaneously pouring billions into the long-term, hopefully high-growth potential of the cloud and AI infrastructure with CIG.
It's a huge gamble. A dual bet on defending the present while building a very different future.
Okay, let's quickly recap the absolute key takeaways for listeners. First,
First, don't be fooled by headline profit numbers boosted by selling assets. Look at the operational margin pressure in TNT that shows the real cost of the e-commerce war.
second takeaway.
That QZT marketing tool, it's the most concrete, controllable lever they have right now to boost high-margin profits in the core domestic business. Watch that adoption rate.
And third, the big picture.
The open-source Quinn AI model, that's the long game. It's all about building a global ecosystem that ultimately drives demand back to their proprietary high-margin cloud computing services.
We saw Jack Ma take down eBay, this global giant, with incredible boldness and clever tools like Alipay back in the day.
We did, but now the threats are different. Multiple agile domestic rivals like PDD and Douyin, plus that constant state oversight.
Which leaves us with a final, maybe provocative thought for you, the listener, to chew on.
Does this radical decentralization, this 1 plus 6 plus n structure, does it actually give Alibaba the speed and flexibility, the agility they need to win these new kinds of battles?
Or is there a risk that by breaking up the monolith, they actually fracture the very scale, the unified market power that made the original Alibaba so dominant and seemingly unstoppable in the first place?
A fascinating question. Agility versus scale, that's the tightrope they're walking.